A registered retirement savings plan, or RRSP, is like an umbrella. It shelters investments, allowing them to grow tax-free until you're ready to retire. An RRSP can hold a variety of investments, from cash and stocks to mutual funds. Used carefully, an RRSP can save you thousands of dollars in tax. There are 2 reasons why you should set up an RRSP. First, it reduces your taxable income in the year you contribute. Second, capital gains as well as interest and dividend income earned on investments within an RRSP aren't immediately taxable. You'll have to pay taxes when you make a withdrawal. Let's look at a few examples to illustrate how this works. Say you're 30 years old in Ontario, making $90,000 a year, and you don't contribute to an RRSP. Your highest marginal tax rate is then 37.91%, and you owe $23,136 in tax. On the other hand, if you chose to contribute $10,000 to your RRSP, this amount is subtracted from your taxable income, meaning it's reduced to $80,000. The reduction in taxable income also means your marginal tax rate is also reduced to 31.48% from 37.91%. Overall, this investment reduces your taxes payable to $19,817, saving you $3,319 in tax. In addition to what you've saved in taxes, you also benefit from the magic of compound interest. If we assume a rate of return of 4% compounded annually, your $10,000 investment will grow tax-free to $37,943 over the next 35 years. Now, let's look at scenario 3. You've already paid income tax throughout the year based on your $90,000 annual income and made a $10,000 contribution to an RRSP. You will actually be owed a $3,320 tax refund. As we've seen from scenario 2, by contributing to an RRSP, you've actually lowered both your taxable income to $80,000 and your marginal tax rate to 31.48%, which means you were overtaxed throughout the year. Now let's assume you've chosen to increase the size of your investment by adding your $3,320 refund to your original $10,000 contribution. Your total RRSP contribution for the year would now be $13,320. At an annual rate of return of 4%, this investment will grow to $52,562 over a 35-year period. Now let's examine how withdrawing the funds from your RRSP at retirement can impact the value of your investment. Any funds you choose to withdraw at age 65 will be taxed at your future tax rate. For the sake of simplicity, let's say your only income at age 65 is the $52,562 from the previous example. This means your highest marginal tax rate is only 29.65%, and your income tax payable is just $9,070, significantly less than what you would have paid during your peak working years. But what is the actual value of this investment from scenario 3? In the end, your investment will be worth $52,562. Once you subtract the $9,070 in taxes paid at withdrawal, the total value of your investment is $43,492. By now, it should be clear why you should have an RRSP. But if you're asking yourself, how can I open one? It's easy. Anyone can start contributing to an RRSP so long as they're under 71 years of age and file an income tax return. RRSPs can be opened at most financial institutions, such as banks, credit unions, and online brokerages. Did you know RRSPs have an annual contribution limit? It is also known as the deduction limit, which is the lesser of 18% of your earned income in the previous year, or the maximum contribution limit, which changes every year. In 2017, the maximum contribution limit was $26,010. It's important to remember that unused contributions are carried forward each year, so don't worry if you're unable to max out your yearly contribution. Any unused contribution room will continue to accumulate each year until you're ready and able to contribute more. So how would you calculate your 2017 contribution room? First, we need to calculate your 2016 earned income. This includes all taxable income for the year. Let's say you earned $60,000 in employment income. $20,000 in rental income, $10,000 from a side business. Your total income for 2016 would be $90,000. Now, we can calculate our 2017 contribution limit. As we've learned, this is equal to the lesser of 18% of your earned income, or the yearly maximum contribution amount. Since the yearly maximum amount is $26,010, 18% of our earned income would be the lesser at just $16,200. Currently, our 2017 limit is the $16,200, but we still need to account for any unused contribution room from the previous tax year. Let's say you have $5,000 in unused RRSP contribution room. This would increase your eligible 2017 limit to $21,200. It's important to note that if you contribute too much to your RRSP, you could be hit with a 1% monthly tax penalty on excess contributions. The exception being that over your lifetime, you're allowed to contribute up to $2,000 penalty-free. After that, you're required to pay the penalty. But what happens if you want to withdraw some of this money from your RRSP before age 71? The simplest answer is you can withdraw it, but unfortunately, it comes at a cost. Any money you withdraw will be subject to a withholding tax of up to 30%, and because the withdrawal is considered taxable income, you may end up paying additional taxes at year-end. A withholding tax is a tax withheld by your financial institution and paid to the government. The amount will vary by province, and the amount you choose to withdraw. Depending on your marginal tax rate, you may owe an additional percentage of tax at tax time, or be entitled to a refund if you've overpaid. Keep in mind that there are two exceptions to the withdrawal rule. The first exception applies if you're a first-time home buyer. Under the home buyer's plan, you and your spouse or partner are eligible to withdraw up to $25,000 per spouse from your RRSP tax-free. However, you must pay back the withdrawn funds in full over a 15-year repayment period. The second exception is the lifelong learning plan. This allows you to withdraw a total of $20,000, up to a maximum of $10,000 annually from your RRSP to fund education for you or your spouse. Unfortunately, this cannot be used to fund a child's education. You must also repay the funds over a 10-year period to avoid paying interest or tax. If you're trying to decide whether to put your money into an RRSP or a TFSA, go with an RRSP if you think you're at or near peak earning potential, as you'll save money on your taxes now. Otherwise, if your current income level is lower than what it will be in the future, then you'll save more money on your taxes if you wait to contribute to your RRSP when your income is higher down the line. Instead, contributing to a TFSA now lets you earn money tax-free later on, when you're in a higher tax bracket. If you think your future income will be significantly lower than what you're earning now, as is typically the case in retirement, then you'll be in a lower tax bracket in the future. You'll enjoy greater tax savings if you contribute to an RRSP now, and you won't have to pay as much tax on your withdrawals when you make them. Avoid using your RRSP for shorter-term savings goals, such as buying a new car or going on vacation. Instead, it should be used for long-term savings goals such as retirement, a first home, or continuing your education. That's everything you need to know about the basics of the Registered Retirement Savings Plan. Thanks for watching.